Welcome back, ladies and gentlemen, and it is that time of the month in which we will have our strategy meeting. This is where we bring part of our trading desk on live so that you can hear the thoughts of what they think might happen over the course of the next month or so. So we're going to talk about some of the key themes and some of the developments in the market, and that means we're going to bring in chart trader, event trader, Blue Chip Trader, and Scalp Trader to spend some time with me going over these markets. And first, I'm going to bring in chart trader Brett Manning. And I find it pretty interesting that we have some very bullish developments over the course of the last couple of days. And the most near term was that we had what we'll call progress in putting together a meeting between the key officials with the Chinese and U.S. trade dispute, and that's going to happen sometime in October. You went out with a short, and you had been handicapping this trade for quite a while, and I wanted to know what your thoughts are as far as, was this quote-unquote progress, or was it just more rigmarole in the course of the trade dispute,
Right.
and what you might learn if the trade works out in either direction, if it works out in your favor, or what you might learn if it doesn't.
Okay, so I think that there's a path of least resistance to market movements that is slightly independent of the headlines, and the reality of the headlines tends to be reinterpreted according to what the market does. So what would I'll start with the second question first, which is what I would learn if it doesn't work out. Is that the market wasn't prepared for a larger time frame correction in a lot of different ways. It is somewhat dependent upon how the trade situation evolves, but I think that is a mascot for a lot of other problems as well. And it really depends on where we are in the cycle and how much risk assumption is out there to still take, particularly in terms of positioning in equities markets. So I think it's possible that my trade will work or not before we know one way or the other whether or not this is genuine progress. In other words, the market, the most important thing to be watching this week is how this week closes. It's more than just the idea that we're getting back around the table with China. I mean, we've seen an apparent resolution to the Hong Kong riots. We have seen an apparent end of the threat of a no-deal Brexit next month. We've seen Russia recommit to the OPEC plus structure. This has all happened in the last 48 hours. And we've seen apparently China and the United States getting set to get back around face-to-face at the table. And the idea that being floated in Chinese press is that China is more hopeful, apparently, for a breakthrough, as they put out. And it's odd for them to use state media to say something like that. So there's a lot going into helping the breakout that we're seeing today. And I would imagine from a short-term sentiment standpoint, sentiment is probably incredibly bullish right now. And it's difficult to find data that would show that, but I would imagine we've seen a huge amount of hedging come off. A lot of money that was on the sidelines that needs to be in the market on an upside move come flooding in. Now, if we do end up rolling back over, I don't think by the end of this week we'll have any resolution to any of those situations, but we will understand more about where the path of least resistance is in this market on a cyclical time frame. And I'm willing to put a position on that because it got exactly to the situation that I was looking for. We got the running breakout above the 50-day, above the range that we'd established in mid-August. We've moved to the other end of the spectrum on a lot of different short-term sentiment indicators to kind of remove all that hedging and remove all that nervousness. And we're up there now. And if this thing rolls back over, it's really going to be in a vulnerable situation because those headlines can shift back the other way at any time. And if we move back into the range now, you've probably got a lot of new exposed vulnerability in the market. And I generally look at trading that way more than trying to predict what the headlines are, trying to figure out how the world is going to look. I try to take advantage of falsifiable predictions on vulnerability and just let it play out. And I'm willing to go ahead and take this loss if the market moves back higher. I've only got a quarter-size position. The loss would be tantamount to a full-size position and a 6-point loss. but I've got plenty of room now, down about 10 points in it. And if we roll back over and we move decisively back under 29.50, I'll add to that position and move my stop up and just let this play out. But to go back to your first question, honestly, I don't think this is progress. I think that I put out a chart book late last week that gave, in writing, my sort of four-prong argument for why I don't think we're going to see a near-term trade deal, no matter whether people come back to the table or not. And I think that that's still in play. I think you've still got a situation where you have to get an extremely powerful deal now, along lines that I don't think China wants to capitulate to, and that the United States will need to get them to capitulate to, where big issues are concerned. Made in China 2025, the One Belt, One Road, the IP theft, all of those things need to be part of that deal. And I don't think China's ready to cave on any of those things. So I don't think you can get a face-saving deal at this point, and I don't think that they're actually ready for a breakthrough. I think that China understands the power of the yuan now. I think that they can devalue and that it has a meaningful impact on how this whole situation plays out. I think that the Chinese leadership is not nearly as politically vulnerable as U.S. leadership, and I think that the polls continue to be a big struggle for Trump, and that really gives China more leverage. So I think, if anything, if there were to be a capitulation, I think that it would be more likely on the U.S. side than on the China side, in terms of trying to come up with something that they can spin. But I think that's awfully difficult here. So I don't think just the fact that they get back to the table necessarily means we're any closer at all to a deal. And I think the market may start to price that in. So there's the reason for the position. There's the reasoning that I have behind it. I think there's vulnerability building up back to the short side. And this is a very headline-driven pop above a resistance level. But if the market does continue to plod higher, it will just mean that's where we are as far as path of least resistance, almost independent of headlines.
All right. And not to mention, we do have the jobs report out tomorrow. How does that weigh into your decision-making processes to whether to hold this overnight and how you're going to play it tomorrow?
I think that if we have a good report, it will probably show a meaningful shift in Fed funds futures, because it's going to get really difficult to them to justify a serious cut if we have a really big positive jobs number at this point. And I don't know how the market's going to take that. That really could play out either way, and it'll be another moment to learn about where the market is in terms of its path of least resistance. But yeah, I mean, I think that it becomes tough, and I think that we've seen in Fed speak lately, and I've noted this a couple times, that I think we've seen a little bit more of a kind of resentment in terms of how they have been treated on Twitter, and that we hadn't seen that for most of the process of this kind of browbeating from the administration. But I think we've started to see it in August, and that could also play into it. If they get really strong data, it's going to be awfully tough. Even if Powell is hoping that he can get somebody on his side, he's not going to want to move if he's going to have about 10 dissents. So it's going to be pretty tricky at that point to kind of lead everybody toward a big cut if the data starts to look just unequivocally good. So I think that may be the more important way that this data is viewed. If it's weak-ish, if it's weak enough to give them cover to cut, the market will probably see that as the most favorable outcome, as long as it's not too weak.
All right, and I think one of the key themes to watch out for, and I honestly don't know where we are in this process just yet, and I'll invite Gavin, Event Trader, to join in if he likes to participate in this section. My question is, where are we on the good news is bad news for the market and bad news is good news, that whole game that we play, as far as where the policy is going to shift, as far as market direction? You know how that's been playing a role for years and years now. And today was one of the first times that we had good data and very positive data, I would say, and yet we still had a nice surge in the market. And I don't know how much that had to do with the sentiment with China, or if there is actually something behind the scenes that, underneath the hood there, that's really driving this thing higher, that maybe, just maybe, we might have good data means good for the market scenario. I don't know where we are, so I'd love to get your take on that.
Yeah, I mean, I think that I think we are in a situation where it could be a little bit more sloped in that direction. Just because I think and this is another big topic in the chart book, was the idea that we are, and this is driving the euro trade as well, that we're in a period where we're starting to kind of lose deeper faith that traditional monetary policy tools are necessarily going to have that much of an impact on intermediate and long-term outcomes. So that would predispose the market to be a little bit more angling toward good news is good, bad news is bad, just because bad news doesn't necessarily mean that it's going to bring something to the table that changes the game. But I think that there's probably still going to be a knee-jerk in the direction of too good a news at this point that takes the Fed back out of its easing cycle would probably be a little bit damaging. So I think there's a sweet spot to appreciate. I don't know if you'd agree with that, Gav.
Yeah, no, I agree completely with that. I don't know, Brett, if you happen to see, and we've talked about this last few meetings, we get that Wall Street Journal article out right at the end of the quiet period, and that's generally been a pretty good gauge on where the Fed's going. And with that, last night we had the Fed likely to do a 25 basis point cut. And I think that's pretty much cemented into the markets. But I would agree with you. I don't think that there's been enough economic data out there to suggest that this is going to be a full tightening cycle. I don't think that there's any chance for a 50 basis point cut. We still have the jobs number tomorrow, of course, and probably more importantly than that jobs number is the Powell speech shortly after it. He'll be at a conference with the Swiss National Bankers and be providing his latest economic outlook. So that's certainly going to factor in, but I really don't see that moving the dial too much, to be perfectly honest, just because I feel that the 25 basis point cut is cemented. As far as good news is bad news or vice versa, I don't think the market really knows exactly what to do on that. I kind of think what Brett was talking about with trying to find out where the path of least resistance is to the markets. We'll get a better idea of that when after Powell speaks. And to be honest, I think that the 25 basis points cut in is priced in, and I don't see the market reacting too strongly one way or the other at this point in terms of that being the primary catalyst. I think if we did sell off, it would be like Brett was saying, that was just simply the path of least resistance to the downside. So in terms of a good news is bad news cycle, I don't know if we're in that. At least on a macro side of things, I think I'd be more interested in seeing if companies come out and are guiding lower in the next couple of weeks. That's going to be a pretty key item. We saw Tyson Foods come out, and they've been trending lower even on a day like today where they got the 50-day moving average coming in. Haven't really been able to see much of a bounce off of the sell-off and reaction, and looking for moves like that to get a pretty good idea, because I think the macro is kind of a little bit on autopilot at the moment. That could certainly change following Powell. I just don't expect it to. I think we've got a litany of things coming up outside of the trade talks on the central bank side that we're going to want to watch market reaction, and that starts September 12th with the ECB, and then flows into September 18th with the Fed decision, and then the Bank of Japan after that. Once we kind of clear the decks, I think that there's going to be a realization that monetary policy isn't going to be as supportive to the markets, and I'll be curious to see how we react to that. So I do think that we see a little bit of a sideways pattern until those events are removed from the calendar and people have a fairer idea of where we're going on that side. And certainly the bond markets, where you're going to want to take your lead on that rather than the gyrations in the stock market, I would say. So, and then that'll bring us into October, which I just think is going to be huge. Not with, obviously we got those trade talks coming. To Brett's point, this will be the 13th time that the two sides have met, and I would hardly say that we've seen an improvement on the trade front over those 13 meetings. If anything, it's very easy to argue that there's been a further decline on that. One of the next headlines we want to keep an eye out for on that trade front is October 1st. We're expecting to see that 250 billion tranche of tariffs move to 30% from 25%. We've seen some olive branches come from China. If we see the Trump administration come out and say that they will delay that hike, which I do think we will see, then that could provide another extra boost to the markets here. But I think that's going to make us vulnerable to the downside on the idea that we will get the monetary policy meetings from the three big central banks. None of them will really move too much, or at least as much as some people had hoped. And then, the reality of that trade expectation probably getting a little ahead of itself, and the reality of perhaps some earnings warnings. I think it's just going to make valuations anything over 3,000 in the S&P very difficult to justify.
All right, and before we move away from you, Brett, I want to ask you a couple of opinions on some of the markets that you've been focusing on. The first one being the euro. If one did not already have a short position on there, would this little pullback that we've seen into kind of that breakout zone in the euro, we had a little pullback today and it's sold off a little bit. Would this be a place where somebody could initiate a position and feel comfortable?
Yeah, I suppose. I mean, you need to be comfortable with what you're doing with risk and what you're doing with sizing, but there is, I suppose there's a, I would like the pattern more if we flashed up one more time, maybe above 1.11 and then came back down. I like that kind of double rejection in a situation like this, and I think that if that were to happen, I might add to my own position. But the larger thesis, I think, is still kind of active. We could see some kind of shift. I think this bounce is, I mean, part of it is the no deal Brexit coming off the table. Part of it is, we've got probably too much shorting piled in kind of toward the bottom of that move, and they're a little bit vulnerable when you start to get a little bit of a bounce. But I think the larger idea that I talked about in the chart book is still very much something that's on the table, and that is that we're predisposed towards some kind of pricing in of some sort of euro crisis coming as we start to move away from a long-term policy regime that's so focused on what central banks can do and becomes more focused on what national balance sheets can do. So I think that that's still in play, and I think the larger thesis is still in play, and the position is still up pretty nicely, and I think it's tracking well. So yeah, I mean, as far as the mode of behavior, it's there. You just need to be precise about how you executed that. And I'm not sure whether I would enter right now personally. I like where I got in, but I may add to the position if we get a double rejection off of that 1.11 area roughly. We didn't quite get up there at the highs last night and this morning, but I think that if we poke just above the tail from today and then came back down below 1.105, I would probably add to that position. I would feel pretty comfortable with that. So maybe you just want to wait and see if that happens and see if I add and then do that. One other point I wanted to make, Gavin brought up just what we've seen from bond market and interest rates, and I think that there's an interesting. So one of the theses that Gavin and I talked about late last year as a coming problem for roughly Q3 this year is starting to look at some of the difficulties when we had interest rates where they were last October, looking at some of the difficulties companies were going to have starting to roll over a sort of historic level of corporate debt, and starting to see, when you start to roll that over, you're going to be rolling it over at much higher interest rates. So one of the big pluses of what's happened in the bond market is what we're seeing with corporate refis right now. And I mean, Deere just set an all-time record with 30-year debt for 2.77%. Apple, we just
they've been scrambling into that market.
Yeah, right. And $7 billion for Apple here at nothing. So, I mean, that's a longer-term positive for the cycle. Obviously, the interest rates are where they are for a reason, but it takes one of those big risks off the table, at least to some extent. You're seeing a lot of these big companies be able to refinance at advantageous interest rate shifts on the rollover, which is pretty important.
GE being a really key area to watch too in this too.
Yeah.
All right, Gavin, why don't we talk about GE just a little bit here, because ever since we had the report from, I forget his name, but
Tusa?
Yeah.
Tusa. Or right. Are you talking about the
fraud, remember when he came out with the fraud?
Yeah.
what was his name? The Enron guy, right?
Yeah, going blank on it myself here, but yeah, that was August 15th. We can't.
Right.
That
So
report
we've
came out.
we've seen quite a rebound in that, and you've been interested in this name in the past. Have you drawn any interest in this one so far?
No, not really. I mean, I just don't see a rush to get in there. I'd prefer to see a little bit of a change on the operations side. Markopoulos is the gentleman's name, by the way. It is coming up to test its 200-day moving average here, right at 925. Right now, seeing an early rejection. But, I wasn't getting overly concerned about the Markopoulos report. We saw Culp come out and defend naturally, but Drunken Miller also was pretty quick to defend there. Their audit chair committee was out, and there was a Morgan Stanley note out, I believe, today. I haven't had a chance to find that, but be curious to see what they're looking at. I'd love to see JP Morgan, Stephen Tusa, come out with his latest, because he's certainly been an axe on that. But for me, I just think that this has a lot more sideways direction going on. I think that there's still plenty of time to get involved with the name if they are in the midst of a turnaround. And a lot of this, again, is on the operational side, too, which hasn't been overly attractive. And I just kind of laid out my thesis for my concern around October and those Q3 earnings reports. And certainly GE would be at the center of being a multinational corp and an MNC on the industrial side that could see those slowdown in orders really impacting it from uncertainty around the trade. So I just don't see a rush to be in and be right here at the moment. I'm perfectly fine. I think we see this just cut in between that 8 and 10 level over the next couple of months. And when I get a little bit more clarity around that is something that I'd be looking a little bit more into. But what my point with Brent and the corporate debt side is that GE is just such a large player in that market that, I think it's a key read. If you see this breaking down below 8, then that's going to be, that probably means that the corporate debt markets and seen a little bit of cracking going on, and I think that's the larger issue for the markets. So GE, I'm just watching as a macro here, but like I was saying, I'm just kind of expecting a little bit more sideways direction in this stock.
All right. Well, one of the names that you took advantage of and made some good money today was in WORK. And the reason why I bring this one up is because we've had a lot of questions regarding why were you so comfortable getting into this one right out of the gate and then adding to it. And obviously it worked out very well for you, but help the listeners understand what your thought process was in this name.
Yeah, I mean, I just saw a lot of commentary around the name about people being comfortable with this decline. Obviously, stock opened up for trade at 38.50, popped to 42 on that day, and then had just been on a steady decline. This was one of the bigger names or recent IPOs that we've seen, and the 26 level was the direct listing price. So I was looking for some solid support in there, and once I saw that come in and we started edging back towards 27 and got over it, that's when I wanted to add to it. I felt that it had a lot of the same characteristics that we saw in Fastly a couple of weeks ago, which I played poorly, and luckily I was able to learn from that and didn't panic out. Not that I didn't panic out, I wasn't in work, but once I saw this as a level, I thought that we could see that gap fill up, which would be from the 31 area. And that's exactly what we got. Now we're seeing that level rejected a little bit here, and the stock rolling back over. But at this point, I'm only at a quarter size. I got my stops right at entry, so I feel pretty comfortable there. And, it was a trade I felt worth taking. I did leave myself a wide risk there at $3, which is a lot wider than I would normally do on this. But again, I didn't know if we'd see one more flush early on, and I wanted to avoid being whipped out at, say, like a dollar stop at 25, getting stopped out, and then seeing this thing rip back without me. So that's basically what I was looking at with work. I got that last quarter piece on now, and just kind of watching to see. I'm expecting to see another test at 31, and that I'll kind of key off of what it does around there with what I want to do next.
And I think one of the most important things that we might say in this whole entire segment is what you just mentioned, and that was you learned from a mistake that you made in a prior trade that was Fastly, and you utilized what you learned into making some profits in this one today. So kudos to you. That's something that we should all implement into our trading and our investing approach.
And speaking of that, Jim, a segment that I'm going to be starting up, and any of the traders are going to be invited into it, is just trying to keep a diary of all my trades to post to the site with the do's and don'ts of what we're finding out. And I think it'll be particularly interesting around earnings season, because I do tend to trade a lot of earnings reactions, and with that we find a lot of patterns develop over the course of earnings season that hopefully we'll be able to take a lot of advantage of.
All right, that's good, and we'll be looking forward to that as well. All right, Scott, you are one that likes to learn from your mistakes. What have you been doing lately? You've been making some good decisions here. You've been making some good decisions here. That's even more. The money comes from good decisions.
Yeah. Actually, I've still been laying pretty low here. Obviously, August brought around a lot of higher volatility, a lot of chop, a lot of whipsaws. Market seems to be extremely fickle with how it responds to any sort of tweet or headline that comes out about the trade wars that are developing. And really, it just seems to be quickly, changing its mood on a dime, pretty much overnight, like consistently. So when I start to see that type of erratic type of behavior, I definitely tend to pull back in on the reins. I'm more of a swing trader and a momentum trader at heart, and there really hasn't been a whole lot of that going on here, to say the least, the last couple of weeks. Now, coming into September, things started to shape up here a little bit better, and we still have some really strong sectors that are outperforming out there. But today's activity is just, I'm kind of in this between a rock and a hard place still. And I say that because even though the S&P and the Dow and the NASDAQ, QQQs, they're all gapping above those August range highs, as well as their 50-day moving averages, which more often than not, you're going to see me on board. I'm ready to go. Let's trade everything from the long side when that happens. The one caveat is that small caps, the IWMs, and the mid caps, MDY, have not done that. And I always tend to say that these are the more speculative asset groups compared to their larger cap peers. And when I don't see the market really diving in and starting to go after those small to mid cap names, and they see this hesitation, I also tend to have some sort of hesitation. So my overall approach right now for the market is just to have like a healthy skepticism. I guess that's the best way I can use it. Actually, I went to my doctor a week ago. I told him I was going to use that term. So he used the term healthy skepticism, and I figured that was the same way. Now, speaking on the flip side of things, looking out further for the next few months and going into year end. So I was talking to my doctor a week ago, and nothing's wrong with me. I'm not dying. I don't think so. But I was talking to him, and he asked me, obviously, as most people do, what do I think of the market and how do I feel about it? And, and it seems so interesting because whether I'm talking to somebody who's outside of the industry, all they talk about is the political diversification of how the economy is either doing really good or how it's doing really bad, or whether this country's going down the tubes or whether the world is going down the tubes. And it's really such a two-sided, lopsided opinion. Now, I know it always has been, but it seems more so than ever over the last couple of years. And the sentiment seems to be mostly negative and doubtful about the market and whether it can continue to go higher. And if you look at any sort of AAII sentiment readings or investors' intelligence, you're going to see that trend developing. You're going to see this overall negative tone that's been creeping into the market, even more so when you go through a correction and the market's slipped below their 50-day moving averages, and that continues to grow. Now, for me, when I see that kind of extreme negative sentiment on the rise, with the markets only about 5 to 8% off their all-time highs. That's not really something that's going to, in my experience, lead to some sort of bearish market, recession, or anything else like that. It's definitely, there's just too much negative sentiment. And I think if Brett or Gavin can come on here, how are the outflows or redemptions for August looking for like mutual funds and for funds? Does anyone have a reading on that, about how how retailers, withdrew money from the market in August or not? If those levels
Big outflows.
Big outflows, right?
Yeah.
So very
on
large
the equity side.
Yeah, exactly. Obviously.
Big into bonds, big out of stocks. But it's been that way the entire year, almost every week.
Yeah.
Right, but August seemed to have been a pretty excessive month for that. Then you have the rise in the safe haven. Look at REITs during August. Look at utilities. Look at staples. And those are all steadily on the rise throughout August, and even got an inflow of money 2 days ago to kick off September coming off the Labor Day weekend. You saw money rotating into those outperforming sectors for the prior month. And gold is still outperforming, and silver even caught up for whatever reason. That's been taken off to the upside the last couple of weeks. And so there's this flow of money into this safe haven type of environment that's just so aggressive here the last couple of weeks, just because equities came back in 5, 6, 7, 8% because of all this political concern that's out there and all this geopolitical trade war stuff. I think that it's overdone and it's overblown, and I think you have to start, obviously markets go through, natural ebb and flow and little pullbacks, but I think overall you're going to have to give it the benefit of the doubt and start nibbling on the long side if you haven't done so already, and look for a better outcome in, going into year end. With that said, like I said, it's a healthy skepticism that I have, because I don't see small caps and mid caps participating. But if those start to get back above their August resistance levels and back above their 50-day moving averages, then I think you have to be, on board for further upside activity back to the highs.
Hey, Scott, I'm curious, as we head into this month, are there any sectors that you are maybe going to lean towards focusing on, maybe some of the trades that maybe more some than others? I know you got involved in energy a little bit here, and it's a little bit different, actually, you diving into energy, because you're not one to go into a value type scenario when looking at these charts here, and XLE would be one that I would say, you're kind of buying the dip on this one, trying to take advantage of some money flows. You're more of a momentum guy than that. So is there any other sector other than energy that you might be looking at?
Yeah, so for energy, it was strictly a contrarian type of swing trade for me. Again, it was so beaten down throughout August, and it was extending so far away from 50-day, 200-day moving averages. Nobody's bullish on it. I haven't seen an upgrade in energy stock in I can't remember how long. And when those 13F filings came out, nobody was initiating positions in any of these positions. So it's so out of favor. Wall Street hated it. There was a little double bottom being formed, a new support in late August, and I figured, this is a low-risk opportunity to jump on board. A couple divergences and some technical indicators there going into late August, and here it is paying off just for a nice little swing trade. So I'm getting what I wanted out of it. I'm not expecting it to go rip-roaring up the next 3 months or so, but again, I have my risk in place, well-defined off those August lows. So no harm, no foul there if it continues to go higher or if it comes back in. As for other sectors, I am a very big on relative strength and sector rotations and trend following. And I continue to see a lot of strength, not just amongst those defensive sectors, which I'm a little, like I said, those defensive groups like gold and the staples and utilities and bonds. I'm not so keen on jumping in at these levels here. I'd have to see some further pullback or consolidations to make up my mind on that. But there are still leading groups out there. Obviously, semiconductors have been extremely strong here the last 2 or 3 days, making a nice recovery effort above their August range highs, leading the way higher for the technology space. With that said, I'd be a little cautious about software names. I think software names are losing a lot of their luster here the last few weeks. If you take a look at the IGV, which is the software ETF that I like to track, that's still struggling with those August resistance levels and the 50-day moving average. So that's keeping me at bay from jumping into any software names. The HACK ETF, HACK, cybersecurity, I'd also be cautious about that one. Even FDN, which is just your basic overall internet ETF, FDN, still struggling with those August range highs and well below the 50-day moving average. So you're not seeing those, I hate to say FANG names lead the way to the upside, but some of those FANG names just aren't participating, and there just seems to be some more rotation to some stronger groups. Still strong out there would be aerospace and defense. You can look at the ITA ETF or the PPA or the XAR. Those are three aerospace and defense ETFs that have just been stellar year to date and continue to rise into higher ground. Also in the solar space, if you're not keen on the actual petroleum type of names, you can also just take a look at the alternative energy, something like TAN. TAN is the solar ETF that, again, has been a really strong performer year to date in a strong uptrend. Home builders, anything to do with home construction, ITB or XHB ETFs have been year-to-date outperformers, holding up really well. And then finally, I throw out there medical equipment and devices. That's IHI, another really strong performer if you like the healthcare space. This group has just been really strong to the upside there. Two names I just throw out there if you're interested in. I did note that Twitter has been showing really strong relative strength here throughout August, and I do have a nice clean breakout there today above those August resistance levels, so good movement there. Stock looks pretty good above that 40 support level going back to the August lows, as well as the rising 50-day moving average. And then another one I keep on the radar, and I missed this breakout yesterday, but it showed up on a couple of the scans that I run. Akamai, AKAM. This one's breaking out over that $90 resistance level and held up pretty darn well there throughout most of August, and is catching some upside activity there on the heels of like tech names like Roku and whatnot. So AKAM and Twitter are two names that I like in the technology arena if you're looking for something.
All right, next up to bat is Scalp Trader, Damon, and you are certainly no stranger to finding some value in some distressed names. You put one on just yesterday, MMLP. So why don't we start with that one?
Yeah, I think there's a lot of opportunity in the energy space right now, and if we just get a stabilization in energy prices, particularly natural gas, which we started to see a big rally in over the past few weeks. I mean, natural gas is up from $2 to over $2.40 in just a couple of weeks. So some of the names I'm going after are midstream MLPs that typically have long-term take-or-pay contracts. MLP, which I put on yesterday in the spec portfolio, 28% yield. This is a name that's trading, I would say, at distressed levels in that the market cap is a little bit over 100 million. But a couple quarters ago, they cut their distribution by half, and the stock is trading as if people expect them to cut it by half again, which I don't expect to happen. I think they can stabilize the business here, and we'll be able to collect 28% yield. And my price target based on the stabilized yield in the 15% range would put this thing up about 80% from where we bought it. And so it's been doing pretty well past couple of days since we entered yesterday. It's up 6% today. Energy is doing very well overall. Another space is retail. A lot of distressed retail names out there that are starting to tick up. If you look at the percentage gainers list today, I mean, the top of the list are basically retailers. ASNA is up 26%, which is a name I actually own a little bit of that I started buying over the past week or so, added a little bit today. It's not an official holding because it's one of those names that's either going to go bankrupt or it's going to go up 5 to 10 times. So it's one of, so I think there's probably, I don't know, maybe a 40% chance that it goes bankrupt. And I think it could be a big potential winner. So I wanted to keep an eye on. GIII is up 26% today. Signet Jewelers, SIG, is up 22%. Michael's Stores had a big run yesterday. It's up 13% today. I think it's up about 30% over the past couple of days. Party City's up 10% today. So you're starting to see a lot of these distressed value type of names in energy and retail start to tick up pretty dramatically.
All right. And then you were also involved in Lyft. You put that one on as a swing trade and a little scalping going on there, LYFT. Where do you see this one going? How high?
Yeah, I mean, I can see this one rebounding back into the into the low to mid 50s. So, long term, it's yet to be determined where Uber and Lyft will end up. But I think just on a shorter term basis, especially as markets start to turn around and potentially head higher, I think it feels like there was a buyer's strike here, and I think if we start to get some positive spin to the China trade situation, and just stabilization in the economic data, that you could see a lot of these names head higher, and Lyft is one that once it starts pushing, you could see a squeeze back into the low to mid 50s pretty quickly, I think. So I don't like the action today. I mean, so we got a initiation today, I think at Deutsche with a $70 price target. Mm-hmm. Traded up 3-4% in pre-market, and then basically gave back the whole gain. So it has me a little concerned in terms of you don't like to see a stock just give up its entire gain. I think that's probably an indication of that insider selling. Their lockup expired a little bit early, and I think insiders are there, ready to take advantage of any price uptick. So looking for hopefully some type of squeeze action that pushes it back into the low 50s, mid 50s, or just a general stabilization across the markets.
Okay. One of the things that I see from time to time is you'll get that gap open, and then we'll retrace that, and it looks like it did at least somewhat pick up some support right around where the gap was from yesterday, or where we closed yesterday. So that bodes well for a potential squeeze. That would be the late sellers that might have come in, or anybody who wanted to short that pop. So there's that potential for a squeeze there. So all is not lost there in Lyft. I don't see a huge disruption in the chart just yet in LYFT. All right, Damon, is there any other name that you wanted to highlight that you're going to be looking out for over the course of the next month or so?
So today I added back MRRL, which is a 2 times MREIT ETN. We bought it initially, I think, in late December, picked up about 30% gains between capital appreciation and distributions. I took it off, a month or so ago on concerns about the spike in refis, mortgage refis, which would definitely hurt these companies because they tend to buy mortgages at a premium to par, and then if they get refied, then they basically get the mortgages, get the money back at par. So they're losing 4 to 5% on each mortgage, and so had a concern about that. But now that the 10-year rate is seemingly starting to stabilize, I think that could slow down mortgage refis, and I think that could help stabilize the underlying stock prices, which would lead to a lift in MRRL. Dividend yield is probably pretty close to 20%. I think there are going to be some distribution cuts from the underlying components over the next couple of quarters. So I think you're probably end up around 15 to 18%. But yeah, I'm starting to like it again. Started a new position in it earlier today.
All right. Are there any other themes, and this goes out to all the trading desk, is there any other themes that we need to focus on that we might have missed?
I don't have anything to add myself at the moment. Just I am watching some of the early leaders in 2019 to see if that they could continue, and a lot of that would be in the cloud software space. So I think that's a pretty key space to watch when we're seeing a little bit of more of a sideways action going on rather than the just blindly buy and hold. MongoDB is a perfect example of that. Had a pretty nice report couple months ago that probably would have ripped to 180 on the numbers, but we're seeing a little bit less appetite for there. So I guess that's one area that I'm watching just to kind of see how this plays out.
And I think we pretty much laid out all the macro events. We do have the ECB on deck next week. Is that correct?
Yeah, next Thursday, week from today.
Okay. All right. So we definitely have a lot going on with all the macro developments, and we've got well, just 3 more weeks away, and we'll reach the end of the quarter. And then next month, of course, we'll be talking about what we expect for earnings season. As always, gentlemen, thank you so much for your perspectives. Feel free to jump on in, and I'll mention this for all the listeners as well. If you have any questions, feel free to hit us up on that Talk to Us button. Leave your email if you like a response. We'll try to address it on air if we can. But if not, the best way to get a response to any follow-up questions is to leave your email. All right, gentlemen, thank you so much for today. I appreciate it, and I'm sure the listeners do as well.
All right, everyone, have a good one.